We look at what we've had over these last couple of weeks, and the most palpable thing that I've seen is the big move that we've seen with respect to where fixed income futures markets have priced in the likelihood of a June rate rise by the FOMC. That's certainly on the back of, well, we've had a little bit of a stumble here with the weak first quarter GDP numbers, the weak non-farm payrolls number from March. But then we've rebounded very strongly, of course. Now, it's a case where, you've got the likelihood of the Fed going in June now fully priced in the fixed income market, but almost echoing some of the comments that you heard Bill Gates make right there, is that has the equity market fully priced that in? I would say that's certainly the watch point. We'll get a little bit more information of this week. We'll get the CPI data as well as retail sales is coming Friday. That will help really kind of, I think, lock everything down in terms of expectations. But that's what we're watching over this next period, and I think it certainly lends itself to diversification, certainly with respect to equities, and looking maybe for places outside the U.S. where you're going to have a more attractive monetary policy and valuations are going to be more attractive as well.
Where would be more attractive to you amongst the non-US developed markets then, Doug, from a valuation perspective? Do you think that Europe, as the economic backdrop starts to get better there, and it certainly looks as if we've put out a few political fires, haven't we, most recently in France, but also in the Netherlands and Austria, to name a couple of others. Do you think maybe there's more legs in the equity markets in the Eurozone?
No, spot on. I think Europe is where it looks attractive. Fully hedged, I think we could still see some likely volatility around currency. But yes, in Europe it looks attractive. As you said, the ECB has kind of laid its path forward with respect to how it's going to potentially extract itself from quantitative easing in a very stable and anticipatable perspective. Valuations more attractive, and yeah, we've finally gotten through at least the most recent batch of the political environment there. Look, it was for the most part a fait accompli, if you will, in France after we got through the first round when we didn't see Mélenchon making it through against Le Pen, but it still is good. But put this in the context. Certainly, pollsters haven't ingratiated themselves with great outcomes over the last 12 months. But when you compare this to, say, the surprise we had in Brexit, that was a few points different when we went into the vote. In the United States, 3 to 6 points maybe different as we came into the election. This was 25 to 30 points coming into this one. So that's why it wasn't too big a surprise that there wasn't a big relief response as we got the final outcome here on Sunday.